Level 1, the direct deposit trap. You set up direct deposit because it was easier. Maybe your employer required it. Maybe the bank offered you a fee waiver if you did. Either way, the decision felt administrative, neutral, the kind of thing you do once and forget. What you didn't know, what nobody told you, is that the moment your paycheck started landing in that account, you handed the bank something far more valuable than your money. You handed them a pattern. Direct deposit is the single most important data event in consumer banking, not your balance, not your credit score, your direct deposit. Because a direct deposit tells the bank three things simultaneously: how much you earn, how reliably you earn it, and that you have made this institution the center of your financial life. That last part is what they're really after. According to research from the Federal Reserve, customers with direct deposit are dramatically less likely to switch banks than those without it. The industry term for this is primacy. You become the primary financial relationship. And primary relationships are where the extraction happens. Here is the mechanism. Once your paycheck is routing to them automatically, the bank begins profiling your income tier in real time. Not estimated, not approximated. Real-time payroll data, down to the cent, deposited on a predictable schedule. They know your employer, your pay frequency, and your gross amount. Some banks cross-reference this with third-party payroll data providers to confirm and enrich the picture. You are not a customer with a checking account anymore. You are an income stream with a name attached. The trap is not the direct deposit itself. The trap is what the bank does with the certainty it creates. Because certainty changes the risk calculus entirely. A customer who earns $3,400 every 2 weeks, reliably, is a fundamentally different lending target than a customer whose deposits are irregular and unpredictable. The bank can now model your future behavior with accuracy. They know approximately when you'll need an auto loan because they can see when your car repair charges start escalating. They know when you might consider a mortgage because your savings pattern says you're accumulating a down payment. They know when you're financially stressed before you know it yourself because the gap between your deposit and your typical spending rhythm has widened. They are reading a story about your financial life in real time. And you gave them the subscription the day you filed that direct deposit form. What this creates is not just data, it creates leverage. Switching banks requires rerouting your paycheck, updating every automatic payment, waiting for new debit cards, and rebuilding transaction history at the new institution. The CFPB has documented this friction as a significant barrier to competition in retail banking. It is not accidental friction. The entire product structure of direct deposit incentives, the fee waivers, the early access to pay, the sign-up bonuses, is designed to make the first switch easy and every subsequent switch painful. They want you rooted, and they want your income rooted with you. You didn't sign a contract that said your income data could be used to profile, price, and predict you. But you signed the direct deposit form. And in the fine print of the account agreement you didn't read, those two things are the same. Level 2. The income verification loop. You apply for a loan. The bank asks for proof of income. You provide it. Pay stubs, tax returns, bank statements. This feels like a standard process. Due diligence. The bank making sure you can pay back what you're borrowing. And it is that. It is also something else entirely. The income verification process is not a one-time check. It is the moment the bank formalizes its model of you and begins using that model to price every future interaction. The pay stub you handed over to qualify for a $12,000 personal loan becomes the reference point against which your entire banking relationship is now calibrated. Your debt-to-income ratio, your income stability score, your repayment capacity calculation, these are all downstream products of that single verification event. You thought you were applying for a loan. You were actually submitting a financial biography. Here is what that biography is used for that nobody explains at the point of submission. Your income level determines which products the bank's internal system flags you as eligible for. Not just the loan you applied for, but every future product. The targeting algorithms that decide which offers appear in your app, which mailers go to your address, and which branch conversations are initiated by your banker are all seeded from income verification data. A 2023 report from the CFPB on consumer data practices found that income data collected during lending decisions is routinely retained and used in ways that extend significantly beyond the original transaction. The loan officer who verified your income is long gone. The data is not. You verified your income to borrow money. The bank verified your income to understand everything they could sell you next. There is a second dimension to this that is more uncomfortable. Income verification creates a permanent ceiling in the bank's internal risk model. If your verified income is $58,000 annually, that number becomes the anchor point for everything the bank will extend you. The maximum loan amount, the maximum credit line, the maximum mortgage pre-qualification, all of it is modeled against that anchor. The problem is that the anchor is set at the moment of verification, and the model is slow to update when your income grows. Customers who received income-based product limits during a period of lower earnings often find that those limits lag their actual financial reality by months or even years. The bank's model of you is always slightly behind the actual you, and the bank benefits from that lag because underpriced risk on their end means overpriced products on yours. The loop closes like this. You provide income data to get a product. The product is priced using that income data. The income data is retained and used to generate future offers. Those future offers are presented to you as personalized service. The personalization is real, but it is personalized to serve the bank's revenue model, not your financial interests. Both things are presented as the same thing. They are not. Level 3, the spending pattern harvest. Every time you swipe your debit card, a data point is created. You know this in the abstract. What you don't know is the specificity of what that data point contains, who receives it, and what it teaches the system about you in ways you would not choose if you were asked. Transaction data from your bank account contains your merchant name, the merchant category code, the time, the amount, the frequency, and the location. Taken individually, these are receipts. Taken in aggregate over 6 months of spending, they are a behavioral profile of extraordinary granularity. The bank knows you buy gas at the same station every Tuesday, which means they know your commute. They know you spend more at restaurants in the second week of the month, which is when your paycheck has landed, and before your rent has cleared. They know your grocery bill went up 18% in the last 4 months. They know you canceled a streaming service, and they know which one. They know you've been buying supplements from a category of merchants that correlates with specific health conditions. They know all of this because you paid for it with your debit card. Ron Shevlin, banking industry analyst and researcher at Cornerstone Advisors, has written extensively about how transaction data has become the primary raw material of modern retail banking strategy. The phrase he uses is transaction intelligence. It is not hyperbole. Transaction data is more predictive of customer behavior than credit scores, demographic data, or even direct survey responses, because it captures what people actually do rather than what they say they do, or what a score approximates them as likely to do. The bank is not storing your transactions. The bank is reading your transactions. There is a meaningful difference. Here is the human cost of that reading. The spending pattern harvest enables a form of targeting that feels helpful on the surface and is extractive underneath. When the app sends you a notification that says, based on your spending, you might benefit from our overdraft protection. What that sentence means in practice is that the algorithm detected a pattern of low balance spending in the days before your paycheck clears, and the bank has decided the most profitable response to that pattern is to sell you a product that charges you for the gap. The notification is personalized. The product is a fee. The harvest preceded both. Mirza Baradaran, law professor and author of How the Other Half Banks, has documented how data-driven targeting in banking systematically routes customers toward fee-generating products rather than wealth-building ones. The asymmetry is structural. The algorithm's job is to maximize revenue from each customer profile. For customers in lower income tiers, the revenue-maximizing product is almost always the one with the highest fee, because those customers are least able to access alternatives. The spending pattern doesn't just describe you. It determines what you're offered. And the determination is made by a system that has no interest in your financial health. Level 4. The credit score manipulation. Your credit score is a number between 300 and 850. You've been told it measures your credit worthiness. What you haven't been told is that the inputs to that number are partially controlled by the institutions, whose lending decisions the number is supposed to evaluate objectively. This is not a conspiracy. This is the architecture of the system. Income does not appear directly in your credit score. The 3 major bureaus, Equifax, Experian, and TransUnion, do not include income in the standard FICO calculation. Banks know this. What banks also know is that income affects credit score indirectly through a series of mechanisms that are invisible to the average consumer, but extremely visible to lenders. The first mechanism is credit utilization. Banks assign credit limits. The lower your income tier at the time of your initial account opening, the lower your starting credit limit. Your utilization ratio, the percentage of available credit you're using, is one of the most heavily weighted factors in your score. A customer with a $1,500 limit who carries a $600 balance has a 40% utilization ratio, which damages their score. A customer with a $15,000 limit carrying the same $600 balance has a 4% utilization ratio, which helps theirs. Both customers owe the same amount. The lower income customer's score is penalized for it. The credit limit the bank assigned based on your income is now being used as evidence of how you manage credit. The second mechanism is harder to see. Banks report your payment history to credit bureaus, but the timing, categorization, and completeness of that reporting is at the bank's discretion within certain guidelines. Research from the Federal Reserve Bank of Philadelphia found that banks in competitive markets report more complete and favorable data to bureaus than banks in markets with less competition, suggesting that bureau reporting is a strategic tool, not a neutral record-keeping function. The third mechanism is what happens when you apply for credit. Each hard inquiry drops your score by a small amount. Banks that market aggressively to lower-income customers, offering pre-approvals, targeted offers, and direct mail campaigns, generate more applications from those customers. More applications mean more inquiries. More inquiries mean lower scores. Lower scores mean worse rates on future credit. The marketing that was designed to sell you something has the secondary effect of degrading the score that determines what everything else costs you. The cycle does not announce itself. Level 5, the loan pricing engine. Two people sit down at the same bank on the same day to apply for the same loan. They have the same credit score. They want to borrow the same amount for the same purpose. One of them gets offered 7.4%. The other gets offered 11.2%. The difference in total interest paid over the life of that loan is several $1,000s. Neither of them knows this happened to the other. Neither of them has a clear explanation for why. Risk-based pricing is the official answer. Banks price loans based on predicted risk of default, and they use dozens of variables beyond the credit score to calculate that prediction. Income level, income stability, income source, banking relationship depth, account tenure, deposit patterns, spending categories, geographic location, employment sector. All of these feed the pricing model. This is legal. It is disclosed in the fine print as we use many factors to determine your rate. What is not disclosed is which factors, how they're weighted, or how your specific combination of factors was scored against the models used. The rate you receive is not a reflection of your credit worthiness alone. It is a reflection of how profitable the bank believes your profile is. That distinction matters enormously. Two customers with identical credit scores but different income sources. One a salaried employee with direct deposit, one a freelancer with irregular deposits, will receive different rate offers even when the underlying risk of default is statistically similar. The salaried customer has a more predictable payment pattern, yes, but they also generate more ancillary revenue through their account activity. The bank prices that relationship benefit into the rate. The freelancer's unpredictability is penalized twice, once in the risk model and once in the lost relationship premium that the salaried customer effectively receives as a discount. A 2022 analysis by Bloomberg found significant rate disparities in personal loan pricing among major U.S. banks that could not be fully explained by credit score or loan amount alone. The researchers attributed part of the variance to relationship-based pricing that rewards customers with deeper banking histories. This sounds fair until you recognize that relationship depth is itself a product of income stability. The same customers who were locked out of relationship-building products during lower income years are now being charged more for loans because they didn't build those relationships. The pricing engine punishes the past. Level 6. The product steering system. You have never been offered a product that your bank didn't think you could afford. This sounds reassuring. It is not. Product steering is the practice of routing customers towards specific financial products based on their income profile and predicted revenue potential. The CFPB has brought enforcement actions against lenders for illegal steering, directing minority borrowers toward higher-cost loan products regardless of their creditworthiness. But the legal version of steering, the income tier-based version, operates continuously, quietly, and in plain sight. Here is how it works at the product level. Banks have product matrices, internal documents that map customer profiles to offerings. A customer in the lowest income tier is offered checking accounts with high minimum balance requirements or monthly fees, secured credit cards, prepaid card alternatives, and high APR personal loans when credit is extended at all. A customer in the middle tier is offered basic rewards cards, standard auto loans, and introductory savings products. A customer in the upper tier is offered premium rewards cards, lower rate lending, and investment products. The matrix is not posted anywhere, but it governs what appears in your app, what a banker mentions when you call, and what mailer arrives at your address. The product that reaches you is the product the bank decided to send to your income tier. You are choosing from a menu you didn't know was curated. Marisa Baradaran's research and Elizabeth Warren's Senate Banking Committee testimony have both pointed to the same structural problem. Financial products, marketed most aggressively to lower-income customers, are disproportionately the ones that extract the most fees. The $9.95 monthly prepaid card marketed to customers without traditional accounts. The overdraft protection product marketed to customers with irregular income. The rent-to-own financial product partnerships that some banks facilitate for customers who can't access credit. Every one of these products is more expensive, per dollar of financial utility delivered, than the equivalent product offered to wealthier customers. The steering system does not create this disparity. It scales it. It ensures that the expensive products find the customers least equipped to resist them, at the volume needed to make the fee structure profitable. Level 7. The float exploitation. Your paycheck was earned on Friday. You are paid on Friday. The money is in your account on Friday. This sentence contains 3 separate facts, and in the modern banking system, they describe 3 separate events that do not happen simultaneously. Float is the technical term for the gap between when money is initiated and when it settles. When your employer runs payroll on Thursday night, the payment instruction is sent. The money does not physically move the same moment that instruction is sent. In the ACH system, the automated clearinghouse that processes the majority of direct deposit payroll transactions in the United States, standard settlement takes 1 to 2 business days. Your bank often makes the funds available before final settlement, which means for the window between availability and final settlement, your bank is extending you a short-term advance using its own liquidity and earning interest on the float in the process. This sounds like a service, and technically it is. The distortion is in who benefits from the timing and who doesn't. Banks earn float income, the interest on funds held between instruction and settlement, on every transaction moving through their systems. The Federal Reserve estimated this float income across the banking system at several $billion annually across different payment rails. That money does not go to you. It goes to the institution holding the funds in transit. You earn the money. The bank earns the float. This exchange was never presented to you as a negotiation. The more recent controversy involves early direct deposit, a feature that many banks now advertise prominently, offering customers access to their paycheck 2 days early. This is presented as a benefit. What it actually represents is the bank choosing to advance its own funds earlier, before final ACH settlement, to create a loyalty and retention feature that competes on the basis of timing, rather than actual financial improvement. The underlying float economy does not change. The bank still earns on settlement. The early access is marketing. And for customers in lower income tiers who are most likely to need that early access, who are living close enough to their paycheck cycle that 2 days matters, the feature functions as a loyalty mechanism that deepens the direct deposit lock-in discussed in the first level of this conversation. The float is not an accident of the payment system. It is a feature of the payment system that the banking industry has historically resisted reforming at the structural level. Real-time payment rails exist. The FedNow system, launched in 2023, enables instant settlement. Adoption is growing but uneven. The institutions that profit most from float-based timing have the least incentive to move customers toward instant settlement and the most influence over how quickly those alternatives scale. Level 8. The data monetization layer. Everything described in the previous 7 levels is visible, traceable, and regulated to some degree. There is one more layer. It is less visible. It is more profitable. And it is the answer to a question you probably haven't thought to ask. If banking margins are thin and interest rates fluctuate, how do large consumer banks generate the consistent non-interest revenue that their earnings reports show every quarter? Your bank sells data, not your name, not your account number, nothing that would constitute a direct privacy violation under current federal regulation. What they sell is something more valuable. Behavioral signals derived from your transaction history, packaged and transmitted to data brokers, marketing firms, and financial product partners, in formats that are legally defined as aggregated, anonymized, or inferred rather than personal. The distinction between your data and data derived from your activity is the gap through which an entire industry operates. According to reporting by the Wall Street Journal and a subsequent CFPB inquiry initiated in 2023, major U.S. banks transmit transaction-derived consumer data to third parties through a combination of direct data partnerships, marketing co-ops, and credit bureau-adjacent data sharing arrangements. The partners who receive this data include insurance companies pricing policies, retailers doing propensity-to-purchase modeling, credit card companies doing pre-approval targeting, and employers using financial wellness assessments that are built on aggregated transaction profiles. Your transaction history is teaching systems you will never see to make decisions about you that you will never be told are happening. Here is what that means concretely. The insurance company that quotes you a higher premium is using a financial stability score derived partly from your banking behavior. The employer running a background check is potentially accessing a financial responsibility profile that includes your average balance tier. The credit card offer that arrives in your mail was generated because a data broker sold your income tier signal to an issuer running a targeted acquisition campaign. None of these decisions reference your name in the data flow. All of them reference you. The CFPB, under its 2023 and 2024 supervisory actions, began scrutinizing these data practices, specifically down the transfer of transaction data to third parties without clear consumer disclosure. The findings, described in reports published by the Bureau, identified widespread gaps between what consumers are told in account agreements about data use and what actually occurs in practice. The gap is not accidental. It is sized to the minimum required by disclosure law, which was written before the current data economy existed. And here is where all 8 levels converge into a single picture. Your direct deposit made you legible. Your income verification set your ceiling. Your spending patterns made you targetable. Your credit score was shaped by limits your income tier determined. Your loan rate was calculated against a model you never saw. The products you were offered were selected before you knew you were shopping. The timing of your pay cycle generated income for the institution while you waited. and the digital record of every transaction you made, every grocery run, every bill payment, every moment of financial stress captured in a late-night transfer, was synthesized into signals that have been sold, without your knowledge, to systems making decisions about your life. This is not a scandal. This is the architecture. It was built this way, documented in regulatory filings, disclosed in terms of service, and operating exactly as designed. The reason you're only finding out now is not that this information was hidden. It is that the information was scattered across CFPB enforcement actions, Federal Reserve research papers, congressional testimony, and financial journalism in ways that require someone to assemble the complete picture before it becomes legible as a system, rather than a series of unrelated frustrations. The card that declined at the gas station, the loan rate that felt off, the credit limit that never seemed to move, the products that kept showing up in your app at exactly the wrong moment. These were not random. They were outputs of a machine that was reading your income, modeling your behavior, and making decisions about your value, continuously, automatically, and without your participation. Now you've seen the machine. That is not a small thing. Understanding a system is the precondition for navigating it rather than being processed by it. You can choose a credit union with a different incentive structure. You can use a high-yield savings account at an institution that earns on your balance instead of your fees. You can monitor your credit report for the indirect income effects described here. You can read the data sharing section of every account agreement you sign and ask direct questions about third-party data transfers. None of these steps are dramatic. All of them are real. The machine doesn't stop when you understand it. But the machine works best on people who don't know it's running. You know it's running now.